Cool. Well, thank you so much, listeners, for jumping on a call today. My name is Ermek. I'm the CEO of a fintech startup called Richie AI, and we basically do what's called embedded lending infrastructure for B2B SaaS platforms and various marketplaces and payment processors. And I have with me today here Esteban. And is
Hey
it
guys.
Ferrarotti?
Yeah, Ferrarotti, yeah.
Okay, yes. And Esteban is actually our like contributor to Richie AI. And so lots of articles written about different economic topics. We've actually had Esteban help us out with many of those. But that being said, I will let Esteban tell a little bit about himself, and then yeah, we can start from there.
Okay, hi guys. My name is Esteban, as Ermek said. I work as a financial consultant and also as a professor and career director at the university in Argentina, where I live. I'm from Buenos Aires. And I've been working in financial sector since, I don't know, 15 years at least. So I really love talking about financial topics and writing articles. So that's what I like to do, you know, something that you have to do, the work that you have to do, and the work that you like to do. So participating in this kind of podcast or writing articles is something that I really like to do. So it's a pleasure to be here with you guys.
Cool. That sounds really exciting. And like the first question that I would have for you, and then this is more of like the topic of today's discussion. We wanted to basically discuss what's happening with SVB, and I mean everyone is discussing SVB, but there's some updates about it, obviously. But like as a larger picture into the financial markets. But before we kind of jump into that, and like I also like I'm a big fan of economic topics and stuff, but I wanted to ask you, like, what's your train of thought? Meaning, like, what kind of base do you assign yourself to be part of? Like, are you more of like an orthodox economist, or are you more of like a heterodox? Like, are you more?
That's an interesting question. I mean, I think I think that today's world need like more pragmatism, you know, like more pragmatic economy. So decision makers, right? So theoretical models are okay. I mean, capitalism is great. We all know the virtues and the defects of that. I mean, we all know the models, but at the end, governments never follow like one specific model, right? So actually in the States, you know, it's to say like the most capitalist economy in the world, and there are some decisions that are not like truly capitalist, right, or truly orthodox. So I think that they are more of the idea that governments should take the decisions thinking on the people, thinking on the benefit of the society, of the people that live in the country, and that's it, right? Economic models obviously are useful. They are the basics. They are the models that design the economy that we have today. But at the end, it's just decision making. It's just that.
Yes. Yeah, because my view into it is a little bit not classical, I think, right? Like I don't view it as this very much like super straight up like centrist kind of like liberal economy kind of view. Like I have a little bit more of a conservative, like libertarian views on some parts of it. And in even like a little bit of an anti-establishment views in some other parts of it. So it kind of gives me this little bit of a different approach to it. And like I would probably align myself a little bit more with Peter Thiel in that sense than with some peoples at the treasury today, you know. So that's why it's interesting.
Yeah, and I agree with some part of that. I mean, regulation is necessary at some point because it avoids very much of crisis that could happen. I mean, if you take Silicon Valley Bank, for example, the fact that they were investing or lending 110% of the deposits they have from their customers. I mean, doesn't sound logic in a risky environment. So regulation there could maybe could have avoided the crisis of Silicon Valley Bank. But the excess of regulation isn't good either, right? I mean, regulation prevents countries from growing or companies from growing. Companies need their freedom to grow, right? So they need to be able to make decisions with freedom without having to look at thousands and thousands of laws and regulations. So I think that some regulation is necessary. Excess of regulation doesn't help by any chance. So yeah.
So before we kind of jump into our topic, I want to give a little bit of a timeline on this. So what happened is, well, everyone knows that. I think we can just talk a little bit about what happened in the storyline. So basically, everyone knows, I guess it's not a secret at this point, is that SVB had lots of their cash stored in. I mean, this is a very cash-heavy kind of bank. It used to be.
Yeah.
Why? Because the venture funds held their money. We actually had our own bank account at SVB as well. We were in trouble a bit as well. So SVB had lots of money in cash just being stored there. They didn't know what to do, and they they decided to go very secure strategy that seemed to be very secure. It's like, oh, let's do T-bills or let's do treasury bills. And yeah, this is the safest option. I mean, because everyone in the classical orthodox model or orthodox economy will tell you, oh, this is the safest,
Yeah.
the safest security that you must include in your portfolio. What happened as a result of it? Well, everyone knows that because of the high inflation, FRS had to, Federal Reserve had to increase their interest rate, and and they kicked it to 4 point something at the
5% now. So yeah.
Yeah, 4.75 now, even 5. So what happened is that all those T-bills just sank in their value, and all the banks had that problem. So what happened is early in March 9th, that started concerning most of the venture funds and some of the financial markets. So SVB shares started tanking. And I think it's somewhere on the evening of Thursday. Was it Thursday, March 9?
Yeah.
When
9,
venture
yeah.
funds actually, venture funds started sharing the news that companies should start withdrawing money out of SVB and moving them to other banks.
Yeah.
And some other banks like Brex and some other interesting neobanks had big influx of money. So it started being a little bit concerning, but nothing happened. It was still kind of very just a concern, or early on concern. What happened is on March 10, which is Friday, and I believe someone said that at 10 a.m. there's actually a little bit of an interesting personal story to it as well, but I'll cover it in a bit. But at 10 a.m., California Department of Finance actually shut down SVB, and it was the first. It was not shut down by the FDIC, right? It was shut down by the state.
By California, yeah.
And then FDIC stepped in as well a little bit later on the day, on Friday, March 10. I believe there was lots of speculations. Nobody knew what's going to happen. There was a big number of other banks going behind it, and FDIC. So yeah, everyone was shocked over the weekend. Nobody knew what to do. And on Monday, it was officially collapsed, right? Was it? Or
yeah, actually during the weekend, I think that Yellen was the one that said that the government was going to cover all the deposits. So they tried to to bring some calm to the markets during the weekend by saying, okay, if the FDIC can cover them, then the government will do. But that didn't work very much because on Monday it was chaos anyway. I mean, everyone was trying to get their money out of the bank. So yeah.
That's crazy. That's crazy. And I know that still though on Monday, I think they did cover all the deposits, but they did not actually save the bank in a way, right? They
just covered the deposits, yeah, and they put the bank on sale. I mean, and it was just I think that yesterday was confirmed that First Citizens Bank was the one that bought Silicon Valley Bank, right? So yeah.
That's also an interesting story because we have some insight into it as well. Not real insight, but we used to. In our primary venture fund is Charlotte, North Carolina based, and that bank is a Raleigh, North Carolina based bank. So it's interesting what's going to happen there because this is not really that of a traditional financial institution in a way that's like a New York type of like Goldman Sachs.
Yeah.
Like everyone's expecting JP Morgan to buy it out or Morgan Stanley or Goldman Sachs, but somehow like some random North Carolina bank stepped in, so it's
I mean, also it's a family controlled bank, right? So it's not like you say, not a huge corporation or one of the top 10 banks. I mean, I think it's one of the top 20 First Citizens Bank, and it's a family controlled business, right? So yeah, it's quite small. I didn't expect that either.
Yes. And so so the timeline is like that, and then there were some other banks that started shutting down, right? They're just about the same time. So there was Signature Bank, then was other
First Republic had problems. Well, Credit Suisse in Europe.
Yes. And then they forced them to buy it, but so everyone knows what the problem is. It's interesting that the Federal Reserve did not step back. They actually continued increasing the rate.
Yeah.
Right.
Well, I mean, the Federal Reserve is now like in between the rock and the hard place. It's I win the war against inflation or destroying the banking system, or I save the economy and the banking system by letting go the inflation, right? I mean, I think that up to now, Powell has been quite explicit about trying to get down inflation, right? They don't want the American economy to go again into what happened in the 70s or in the 80s, where they stopped raising the interest rates too soon, and that make inflation grow. I think that up to 12%, something like that was during the 70s and the 80s. So they want to prevent that, and to prevent that, they had to rise interest rates. I mean, there is no other way to do it, or at least from their perspective, there's no other way to do it. They need to crash the economy, and that is what they are going to do, right? Or that is what it seems like what they are going to do. So yeah, I mean, they are estimating like 1 or 2 more rises in the interest rates. Some banks are saying that the rates could be up to 6%. I don't think that they will go that high. I think that they will do like 1 more increase of another quarter point to 5.25, and that will be it. They will sustain it there for a couple of months till they pivot to reduce the rates. But they seem determined to fight inflation, right? So whatever it costs. I think that's the equation now.
Yeah, that's actually interesting because there is like some conspiracy theories around it, but like I'm not gonna jump into that. We will touch it at the end of it. But those are like really interesting stuff. So there are lots of other banks that are actually in kind of the same scary situation, right? Do you know anything?
Yeah, actually, there is a calculation, an estimation that banks in the US in general have around $620 billion of unrealized losses due to the bonds. So it's quite scary because it's a very, very large number, you know. I mean, up to now, we only had like small banks crashing, right? So Signature Bank was a small bank. Silicon Valley Bank was like I think the 17th largest bank, but it's not on the top 5 or the top 10. Credit Suisse was the first really big bank in having problems, but Credit Suisse has also a history of having problems and scandals. I mean, it's a bank that, despite being one of the top 10 banks of the world or top 30 banks of the world, have always had several scandals and problems. And luckily, the Swiss government went in there and it was solved quickly with USB acquiring it. Now it's Deutsche Bank apparently having problems. That's a big one. We have to pray for Deutsche Bank not falling, because that would be a great deal. I mean, it's one of the largest banks in the world. But up to now, if we look at the top American banks, you know, US Bank, Bank of America, JP Morgan, Goldman Sachs, they are not reporting any problems. So I think that the situation is some kind contained, you know. It's a fragile containment, but contained anyway, you know. That's how I see it.
Yeah, everyone is talking about Deutsche Bank and also America, right? As like the most like in the riskier zone.
Yeah, they are banks called like they are in a list of banks that are called like banks of economic systemic risk. They are banks that simply cannot run out of money. I mean, if one of those banks run out of money, the world could go into a crisis like 2008, right? Like Lehman Brothers. So, I mean, back in 2008, for some particular reason that I think that no one can explain, the US government let Lehman Brothers fall into a crisis, and that was the beginning of everything, right? But I mean, it was the end, because the beginning was why, you know, the creation, the subprime and that. But maybe if the government back in that time saved Lehman Brothers, the proportion of the crisis or the impact of the crisis would have been much less. I don't think that they will make the same mistake today. I don't see the US government or the German government or the European Central Bank letting a huge bank like Deutsche Bank or like Bank of America run out of money. I really don't see that scenario. It would be catastrophic if they do that. I mean, it would be really catastrophic if they do that.
Especially Deutsche Bank, it's a very systemic bank for the whole.
Yeah.
You know.
Yeah, I mean, Deutsche Bank and Credit Suisse are like the biggest banks in the world. That's why the Credit Suisse, you know, the Credit Suisse crisis was solved in just 3 days. I mean, or 4 days. I mean, they had a crisis. The next day, the Swiss government lent the bank like $56 billion, and 2 days later, it was acquired by UBS. So I mean, it was they moved really fast to prevent Credit Suisse from crashing. And I think that the German government will do the same with Deutsche Bank. I don't think that they will let Deutsche Bank crash. I don't see that coming. It would be really harmful for the economy. I mean, we now have a world economy that is really fragile, with many countries going into recession, with the possibility of a world recession. I don't remember now. I think that it was Goldman Sachs that made like a calculation, and they said that it was like a 98% chance that the world could go into recession in the second half of 2023. So I mean, the system is really fragile. So if some of these major banks crashes, we will have a 2008 crisis again. I mean, it will be inevitable.
And that, because of that, actually, multiple people say that decision of increasing the interest rate only by 25 basis points versus 50 basis points that everyone predicted initially was a compromise solution done by FRS? Do you think that's what was possible?
Yeah, that's explanation. I mean, back in I think that January, the probability calculated for a 50 half point increase in the rate was like 70 something percent, right? So everyone expected an increase in rates of 0.5%, mainly because when they looked at the labor market, unemployment was not rising. I mean, the labor market was still too strong. So they need to weaken the economy for inflation to fall. And with the 5%, with the 0.5% increase, they were closer to that. After all these problems with Silicon Valley Bank and everything that came along, they decided to just elevate the rate in 0.25%. So yeah, that was the main reason. I mean, they couldn't. I mean, the possibility of not raising the rates was on the table, but I mean the fight against inflation must continue. I mean they cannot stop that. I mean they cannot back from that. If not, they will have the same crisis that America lived in the 80s, where the inflation was peaking all the time, and they managed to control it, and they decided to stop raising rates too soon, so inflation peaked again, and again then control it, and again that cycle of letting the rates go too soon. So I don't think that they will make the same mistakes right now. I don't see that happening.
Wasn't like the interest rate about 18% at the time of Reagan was in the office or something?
Yeah, I mean, I don't remember the exact number, but it was 12%, 15%, something like that. Yes, it was the highest record of inflation in the U.S. history. So yeah,
it was a pretty too, right? I'm actually check on it. Yeah, that's interesting. What about how it's going to affect all this financial SVB situation? How will it affect just startup? Okay, so there are two parts to SVB, right? One is SVB as a part of economy, just general financial markets, but also SVB is part of this tech world. We are in the startup world, and 50% of venture-backed funds and venture-backed companies actually banked at SVB. How risky is it now for startups to bank? Because this is also what's interesting for me. What I realized is that SVB collapsed, and most of the merchants, most of the startups actually went to some other neobanks. They went to Mercury Bank and Brex, which is interesting because those are those are small banks, and who knows what's going to happen there.
Yeah. I mean, those banks generally offer startups some advantages against huge banks, right? Mainly flexibility. I mean, when you go to a large bank, if you're a small company and you go to a large bank, you will be like 0.0000001% of their revenue, right? So the possibilities that you have there to negotiate better rates for a loan or having more benefits as a corporate account, I mean, you will have less benefits, and also there are banks that have more rules and they are less flexible, right? So that's why most of startups go to these kind of banks that, as they are smaller, they can be more flexible, they can give a better attention, they can provide maybe even better interest rates for loans, and that's mainly the reason. Obviously, the smaller the bank is, the riskier it will be in this context, right? Because I mean, especially with banks that have a lot of corporate accounts, right? So, for example, if you take Bank of America, nearly 90% of the customers of Bank of America are, or I think that more than 90%, are just like regular people, right? People that have an account, workers that have their accounts on the bank, and that's it. So in order to have a bank run in Bank of America, you need like thousands of people going at the same time to the bank, and that is less probable. In the case of smaller banks that work mainly with corporate accounts, like for example Silicon Valley Bank, I think Silicon Valley Bank had like 50% of the accounts of the customers were corporate accounts, and in that case, if just I don't know 10% of the customers want their money at the same time, you won't be able to pay them. You know, it's you will have a bank run. It's easier to have a bank run in smaller banks, especially when those smaller banks are mainly corporate banks, you know, that have corporate accounts. So yeah, I mean, if you now move your money from Silicon Valley Bank to another similar bank in terms of percentage of customers that are corporate accounts, and also in terms of percentage of deposits lent or invested, if you go to a bank of same configuration, you will have troubles. I mean, in fact, Signature Bank crashed, or Signature Bank ran out of money because of Silicon Valley Bank. They are similar banks. I mean, they are really similar in terms of the type of customers, in terms of the amount of money they had invested and learned or lent in proportion to their deposits. And as they were similar, the customers in Signature Bank said, okay, if these banks fall, well, I mean, mine could fall also. So it was like more contagion effect than a real crisis in Signature Bank. So yeah,
it's actually a very good point. So and because startups usually don't like, so just like you said, they have corporate accounts, but since all of their accounts were startups that also had venture funds above that, and so there was just a few venture funds, like maybe 20 venture funds, like 20 big venture funds that said to all their portfolio companies to withdraw money, and then all of a sudden you have
I mean, if you try to do that in a bank, like, I mean, let's say the same happened with Bank of America, right? Since Bank of America has very little customers that are corporate accounts, I mean, and also have much more money, and they have less money invested or lent. For example, I don't remember the exact number, but I think that by the time of the crash of Silicon Valley Bank crash, Silicon Valley Bank had a proportion of 110% of their deposits lent or invested, right? So they nearly didn't have any cash to give to their customers. Bank of America had 80% of their money, of their deposits invested or lent, right? So if the same exact crisis that happened in Silicon Valley Bank would have happened in Bank of America, there wouldn't have been any bank run, because Bank of America would have the money to give back to their customers, and as they don't have any money, or they don't have much corporate customers, the bank run, I mean, wouldn't have been that hard, you know. But yeah, I mean, now all the banks that work with that configuration, a high percentage of their money lent and or invested, and a huge amount of customers, or most amount of customers that are corporate accounts. All the banks with that configuration, with that business model, are at risk, you know, because I mean, venture capitals will care for their money, not for the bank's money. So I mean, if they see any sign of problems, they will say to their customers, hey guys, let's get the money out of there, and they will do so. Yeah, that's a fact.
Wow, this is good to know. Good to know. Yeah, one big question, and then I think I will end with another very, like, kind of a little bit of an interesting question. So the big question is, Silicon Valley Bank ran into this problem. This is not a banking problem. This is a financial markets problem, right?
Yeah.
Like it didn't happen because they had bad bank. Like, I mean, they had an old type of bank. It was like a relationship type of bank. Yes, their online banking experience was horrible.
Yeah, I mean, the problem, I think that it was I mean, we have the environmental problem, right? I mean, the external problem, interest rates, the one that we've been discussing. But I think that in the case of Silicon Valley Bank and this type of banks, they do have an internal problem that is risk management, right? I mean, in a context where the economy is going down, where interest rates are going up, where bonds are falling, like, I mean, they are every day you see how the bonds lose their value. Having 110% of your deposits either lent or invested, it doesn't sound like a proper risk management. It sounds more like I want to make the most money I can make until the show ends, right? So I think that there is some kind of mismanagement there in terms of risk management. But yeah, I mean, obviously the context it's not a banking crisis in terms of profit. It's more like in terms of liquidity. It's more a liquidity problem, a cash problem, rather than an economic issue. Yeah, I agree on that.
And since this was a financial problem, and this is mostly related to financial markets and risk management, just like you said. So I just checked, like, remember I told you the interest rate under Reagan was 20.5%. And that was the highest when they went 20.5. At 20.5, is the economy, like, imagine you just get that guy back to the office.
Let's hope not.
It's not going to be R, it's going to be T, let's say. Let's say T, rate, TR. Let's say that guy somehow gets to the office. I mean, hopefully not, but maybe, who knows? Anyways, and then the interest rate, like, is 20.5 even possible?
No, I think it's impossible. I mean, no, there is no scenario now where we can see a 20%. I've checked previous to this meeting. I've been checking like the forecast of different banks and different economies and some surveys that I saw around there, and the top that I could find was like 6.1 or 6.2%. I mean, that was the pessimist scenario that I could find. Thinking on 20% would send the economy to a multi-year recession. I mean, we could be facing a world recession that could last maybe 5 to 10 years if we raise the interest rate to 20%. Also, because I don't think inflation needs that kind of raise. I mean, inflation has been going down since the peak in, I think that it was June or July last year that went to 9.1%, and it has been going down, maybe not as fast as the Federal Reserve wants, but it has been going down. So I think that they are going to raise like one more time or maybe two more times, like to, I don't know, 5.25, 5.5, and they will remain there. They will still there, or I mean, they will remain the rates there for some months, maybe December, and starting next year, if inflation is a little bit more under control, maybe they will start reducing the interest rates. But yeah, I don't see a 20% scenario. It's too extreme. Yeah, I don't think it's needed either.
Wow, this is good. Yeah, this is understandable. So yeah, I wanted to end this with like one conspiracy kind of thing.
Yeah, go.
But this is an interesting one. So it says that there is an internal battle within the United States. Well, it's obvious, but in a way, between this kind of like a national economy, like real economy people versus the finance people. And that Biden's administration was actually trying to go the national real economy type of way. And that's why they're increasing the interest rate. Someone says that this collapse of SVB was not really, it wasn't natural, but it was kind of man-made, like in a way. And the reason behind it, or how it was done, is basically just to collapse one bank, but that has so much influence on the like IT world, and basically considering that the US in this type of war with China, like informational war, Cold War kind of situation where they need to be, how to say, like they need to make sure that they don't fall behind the technological development versus like China. So some people say that SVB could be actually, like, could have been that ship that was given for this crisis just to stop Federal Reserve from increasing the interest rate further and hurting financial markets. What do you think about that?
If you wanted to attack one bank in the United States, that would be Silicon Valley Bank. I mean, why? It was the bank that had the higher proportion of corporate accounts. It was the bank that had the higher proportion between money invested or lent against deposits. And it was a bank that had most of its customers in the tech sector, that it's one of the most heated sectors by the economy. You know, if you look at the stocks, Nasdaq has fallen a lot more than SP 500, right? So we are talking about the sector where you have the most amount of layoffs and economic problems, plus a bank that had the most proportion of corporate customers in that sector and the most money lent. So if I would be trying to attack the Federal Reserve by saying, okay, you're going to crush us, and this is the way, Silicon Valley Bank was the bank to attack, right? So I don't know if that is real or not. I wouldn't be surprised if it would be like that. I mean, the banking sector has a lot of influence in the government, and when they don't like it. You know, the banking sector likes to have influence on the government, right? So if you look at the 2008 crisis, the way that banks operated and the way that banks acted sounded like, okay, we did a lot of money, now you can save us. You know, like there's a saying in finance related to the banking that says that corporate gains in the banking sector are privatized, you know, are from the banks, and corporate losses in the private sector are socialized, are from the people. That phrase is quite famous, and it's kind of that, you know, because when everything is going well in the economy and banks are making a lot of money and interest rates are 0%, they are like making a lot of money, and all that money is from them, and they pay extremely high cash bonuses to executives, and they just, I mean, they take all the money for themselves. But when the economy crashes and banks start to crash, they ask the government for help, right? They don't bring back all that money and say, okay, let's use all the money that we have gained over this period to survive now that the economy is bad, right? So they just ask the government for money, and the government gives them money, right? During the 2008 crisis, besides Lehman Brothers, the US government rescued a lot of banks with trillions of dollars, right? So now what is happening is that Powell seems to be determined to keep on rising interest rates. So, I mean, this could be like a lesson from the banking sector, right? So if you don't give us the money, we will destroy the economy, you know, because they have the power to do it. I mean, the banking sector has the power to destroy the economy. They have done it before. and as they have the power to build the economy, because the banking sector is key to the growth of any economy, they also have the power to destroy it, and they know it. So, I mean, I wouldn't be surprised, I wouldn't be shocked if this was real, if this is real. And it's true that if you had to choose one bank to attack, that was Silicon Valley Bank. I mean, it was the weakest bank in the US in terms of these indicators that I told you before. So, I mean, I leave to you the decision to believe it or not, but there are some facts that may support that theory.
Yeah, because if that blackmailing actually happened, it seems that yeah, on March 13, which is Monday, the following Monday after it crashed, Biden had a press conference where he said that's how capitalism works. Nobody is going saving these banks. Maybe that was his answer. Who knows? We'll see. Awesome. Well, thank you so much.
We'll see. I think that they will end up saving the banks. I mean, up to now they have tried that. They have tried to force the bank to save themselves, right? So, for example, I know when First Republic had problems, 11 banks gathered like, I don't know, like $30 billion and gave it to First Republic, or UBS buying Credit Suisse. I mean, up to now, the governments here and in Europe have tried to avoid giving huge amount of cash to banks, but I don't think that is really possible. I mean, if we have a systemic bank, a Bank of America, US Bank, no, any of those in real problems, the government will have to give them the money. I mean, they can't let a bank like that crash. I mean, also because we are near the elections in the US. I mean, elections are I mean, right around the corner. So I don't know if Biden's government can afford to have a banking crisis like we had in 2008. I really don't think that he can afford that if he wants to be president again, right? So I think that at the end, the banking sector will receive the money they want to receive. I mean, that's what I think it's more probable.
Okay. Wow, this is interesting. Well, good discussion. Well, thank you, Esteban, for this discussion today. Hopefully, we can continue this because I really liked it. I think we can have some future calls, talks like this, because I think, yeah, we can discuss so many topics, and some topics could be interesting and not. Well, thank you everyone who was listening to this podcast, and we will try to bring on some more insights into different parts of the economic situation and take things from there.
Okay, of course. Yeah, I'm available, and I also, as I